All right, folks, welcome back. This is episode number 10 of the 2022 ICT Mentorship for the YouTube channel. This lecture is going to be teaching implementing economic calendar events with the open. All right, so the economic calendar, many of you probably don't even consider looking at this, but it's important if you're going to be learning how to speculate, study these markets. Certainly, if you're ever going to consider putting live funds in, you really want to know what this calendar says for the day you're going to be trading. Otherwise, you could be surprised, unfortunately, adversely, with a sudden rush of volatility that you wouldn't otherwise expect. This is Thursday's economic calendar for Thursday, February 17th. And not all of these things are going to be heavy hitters for stock indices, but most of them are. And what I'm showing you here is what I teach all my students. I go to forexfactory.com. I use their economic calendar. Here, the medium impact events are like orange, low impact are yellow, and anything that's red, which is not being shown here, would be like a high impact news driver. So when we look at these stock indices, the reason why I teach you 8:30 in the morning, like that's your beginning time to start looking at it, or crosshairs time. The news embargo lifts at this time at 8:30. Typically, there's a bunch of news events that are being ushered into the marketplace at that time. Now, some of these reports or speeches or data points, they may be used as a smokescreen. They may be used as a catalyst to have price go up or down at the time of their release. Other instances, like I'm going to teach tonight, usually there's going to be a build-up or a dropping down in price right before the report comes out. And then the real move starts to ensue. Okay, so it'll make more sense as I get into the actual teachings. So right away, we're looking at the daily chart. And as I mentioned in the previous episode, I outlined this high here and this low, and that was the range we were within. And the 50 level was equilibrium. So again, above equilibrium is what? A premium market. And below 50% is a discount market. So we traded back up into the top end of the range between this low and this high. And between these two levels here, remember I gave you this low and this high. That's a imbalance. Okay, it's a fair value gap. So it's likely to do what? Go back up and rebalance this before going back down. So if we look at the reference points of it being in a premium market or a discount market, but then we have this imbalance and we have a bias that, and it's likely to go down and take out these lows. So what have we said here in short? The market's been going lower. Yes, we took out some sell stops below this low with the sell side liquidity being taken out here. Then a natural retracement, which is reasonable. Then we start to decline. Then we come back up one more time. Failure swing doesn't go above that high. And then it breaks down and it creates an imbalance when it takes out this short-term low. Now, what's the framework here? We rallied, broke below a short-term low, with the model suggesting that these lows may be taken out. So any rally or up-close candle or candles should be viewed as a potential shorting candidate. Now, ring in the imbalance. We traded up into the imbalance. One more day, we swept above it, not by much. Then the next day, we open, we rally just a little bit, and then plunge. We took out the previous day's low and the day before its low. So both of these daily lows have been cleaned out. Now this one is the next one. Then down here. So when I talk about Power 3, I'm specifically dealing with this time frame, the daily chart. If you consider where the market opens, say this is the opening price, in a daily range, if you're expecting it to go down, or maybe you weren't expecting it to go down, you were just looking at the price in your chart, and you see that the opening was here, it rallied a little bit, and it went down, and then closed near the low. Now, that's a rather simplistic overview. This is the market right here. If you understand this, and you can study a daily chart, daily bias will become easier for you if you start implementing it with this mindset. So, if we're bearish, okay, if we're bearish on a market, we're going to anticipate the daily ranges or each one of these candles doing this very thing here. Open, a rally, not much of a rally, but it can make a large wick. It doesn't make a difference. But the general premise is it goes up just to go down and it closes down near its low when it's bearish. Obviously, this would be reversed where the open would be down here near the low and the close would be near the high of the daily candle if it's bullish. But not every single candle in a series of the entire price swing is going to be all up close candles when you're bullish. Conversely, not every candle is going to be a down close candle when you're bearish. This function of Power 3 is how I teach the bias, and I also teach how to submit to the daily range. You have to learn how to hold to the close. If you're going to just day trade and you're not really participating in the sustained moves that's made available in these daily ranges, like today, I mean, look at this move here. That's nice. It's already traded to the top end of that fair value gap, and it's likely to go lower now, taking out this sell side and attacking the sell side over here. All right, let's drop down to an hourly chart. And that fair value gap, the high and the low levels, that's what's being shown here, right there. So watch what happens. The market trades down, finds some support at the low end of the fair value gap, then rallies back up to the high end of the fair value gap, and then breaks right before midnight on the 17th. And then we consolidate, trade back up into what? What is this? What's this right here? It's a fair value gap. Price goes up, rebalances that there. And it's doing it, what time of day? not New York. It's overnight, European London session. London Open, if you know what you're doing with the daily bias, you can catch enormous moves. But sometimes you're going to have to weigh out a lot of give and take back and forth, kind of like today, where the market rebalanced here and then consolidated and waited for a little bit of a push higher. Then the news came out. Okay, so I'm going to hopefully clear that up for you now. All right, 15-minute time frame. I'm going to take a look at this imbalance here. We rode up into that, rebalancing all this movement down. Same thing over here. We have the market drop down, creates a fair value gap here. Doesn't it take out some lows over here? Yes. There's displacement. And then you can have an order to get in short here. But then watch what happens. This little pump up. That might be scary. It could have stopped you out if it went higher. That's the risk in this, folks. I'm not going to give you a silver bullet that removes losing trades. I lose trades too. All right, so we have the morning session starting before 8:30. We have a rally up and then it breaks lower. In this area here, we're going to have to drop down to a lower time frame. But before I do, I want to give you a little bit more details. Think about what I've taught you so far in this teaching for Power 3. The accumulation, manipulation, and distribution cycle of the daily range. If we are trading near the high end of that fair value gap on the daily chart, that's what that level is, okay? When we just drop down to a lower time frame chart. So with this 15-minute time frame chart, the idea is we're expecting this Power 3 formation where it's open, rally, create the high of the day, sell off, and close near the low. That's what we're looking for. Why would that bias be expected on this day? Because we worked the upper end of that fair value gap on the daily chart. Then we had multiple shifts in market structure bearishly when we already have a bearish bias on the daily chart anyway. So it gives you a high probability that this day is going to be a down close day. So this level here, it's dashed. That's the midnight New York opening price. This is what I'm referring to when I'm looking at the opening or Power 3 on a daily chart. That price right there at midnight. Look what's occurring. That right there is equivalent to this little tick on this diagram here. It opens, it trades above the opening, just like that candle does on a daily chart. It opens and goes higher. You want to be selling short here. Why would you want to go short here? Well, it went back up in there and redelivered the downstroke on that paintbrush or roller on the wall. Well, now it's going back up. When it's going up like that, it feels unnatural to go short. Like you don't want to sell short. It's like, this thing's going up. Why would I want to go in there and go short? That's the benefit of studying old data and then reading price, studying it real time without taking any demo trades, without trying to pick the targets. Forget all that. You want to practice for months, reading the tape, studying price action, watching it. Even if you have to watch it with TradingView's market replay function, there's nothing inherently wrong with it. If that's all you have, you can't watch it live. But it is altogether something different and much more beneficial if you can watch the actual live data. All right, so we're looking at the opening price here, and then we're expecting a sell to form. Well, here's that fair value gap. It rallies up into that. Isn't that a sell above the opening price? Yep. Sure is. From that opening price to that high, that's the highest high. Take that range and subtract it from the opening price. That's about in this vicinity here. Okay, right in there. So what's occurring? Well, we have this sell here. Then we have this sell here at the equities opening. And then we have this imbalance in here. So from this range high to that low, multiply that by 2 as a projection. In other words, whatever that low is to that high, that much lower, you'll expect to see a short. And it forms right here. So with this continued teaching here, right below here, what's that? That's sell side liquidity. Relative equal lows. The setups are forming here above the opening price, right here near the opening price, see that? And inside of the range from the high to the opening projected down, it's in that vicinity there. So it's giving you another opportunity. So here's 7 o'clock in the morning. It rallies above these relative equal highs and cleans up the imbalance here. And look at that right there. See that? Remember what I told you? If there's 2 fair value gaps, try to trade it in here, but anticipate and use the money management to allow for your stock to weather a run up into that. And we got it right there. Now, strip it down to what I taught you for the structure of the trade or the framework. Swing high, broken to the upside, taking out buy stops. So buy side liquidity is taken. Then we have a swing low. It's broken. Did these candles come down lethargically? Was it like a slow meander decline? No. It was sudden. It was a lot of momentum. It was energetic. You can't miss those down close candles right there. That's obvious. They stand out, right? So that's how you know you have a shift in market structure. In this area here, it doesn't have a fair value gap. That's okay. This is only a 5-minute chart. This is where we start doing a top-down strip of 5-minute, 4-minute, 3-minute, 2-minute, 1-minute. The first fair value gap we come to, if we find one on a 4-minute, you don't need to go down to a 3. You don't need to go down to a 2. You don't need to go down to a 1. If you go down to a 4, you don't see one, you go down to a 3. If you find one there, you don't go any lower, okay? If you don't find one on a 5, the 4 or the 3 and you go down to the 2 minute and you find it there, that's it. You don't go down to the 1 minute. If you don't find it on the 2 minute and you do find it on the 1 minute, then that's how you trade it. But what if you don't have one on the 1 minute chart? You don't have a trade. How's that for logic? So we have the continuation lower off of a retracement in here. Now this candle, the high of it here, I wish I would have used a lighter color, but this candle's high is right there. Okay. It actually goes just above that one right there. Not by much, but it does. But we don't need that. We don't need that. Watch what happens. Here's the 4 minute chart. We have buy side liquidity here. The candles are a little bit more beefier when we were looking at the previous slide. Look at this one. Look at the candles. They look wonky, don't they? That's what we're looking for. We're looking for clean price action where we can see the nice candlestick formations, where we're seeing the even distribution of the price going higher or lower, in this case going lower, but we're seeing that little break where there's not an even distribution of price. That's the fair value gap. So we have that run above buy side liquidity. After rebalancing over here, it goes above it and it breaks down. So we have an idea, okay, we could potentially see a trade short here. I like this fair value gap, but we also have a little bit of imbalance in here. So I want to trade in here, but my money management has to permit me to weather a run up into this area too. Remember that? That's part of the rules. But in here, we're going a little bit deeper. In my YouTube channel, I teach a breaker pattern, okay? And that is a high, a low, and a higher high. That's what this pattern is here, and we're seeing that return here. So if I see a breaker like this, yes, I think the market could potentially trade up into here, but I'm going to use the breaker's candle and just above that for my stop. So I'm not going to go way up here or way up in here, because my foundation to teaching the ICT breaker is the market's going to mostly stay in the lower half of the breaker candle, which is the down close candle right for the big move up higher, taking out a short-term high. So here's the fair value gap range from the low and the high end, but it's specifically this candle's low and this candle's high right there. Extend that out in time. Look what happens. At 8:28, the candle's showing 8:28 here because it's a 4 minute chart. But once we're trading inside here, all I need to do is trade above this candle's high. I want to be short. Then I'm going to be aiming for those relative equal lows. That's 14,381. Remember that relative equal lows? I said I wish I would have put a line on it. This is the time frame I added the line. It's the 4 minute chart. So hopefully this has helped clear up the idea of bias and power 3. And I will be repeating these themes when it's applicable in the newer videos that come out and examples I'm going to teach with. But for now, notice something. From this low up to this high, it's bullish. Okay? We're expecting bullish prices. This is how you backtest. You tell yourself in your annotations, I was expecting. You're basically lying to yourself in the comments of your chart when you're backtesting. But what you're doing is you're teaching yourself pseudo experience. It's training your subconscious to see this stuff like you saw it live. And when you record it on the chart in your own annotations and you log it and you keep it in your journal, and on the weekends you go back and look at your Monday, Tuesday, Wednesday, Thursday, Friday, and then you look at the previous week and you start looking at these patterns and how it repeats over and over again. When it's bullish, you're trying to stay with the opposite of this. Open near the low, close near the high, but expansion to the upside. So you accumulate longs, manipulate, get people thinking it's going to go lower, and then ram it up higher. Distribute the longs near the close. That's what you're looking for here. If we're bullish here, okay, we're expecting each candle to expand higher. So in other words, the close be higher than the opening on each individual candle. My up candles are green. How many black or down close candles do you see in this price run? 2. Wow. How about this price move here? It's going lower, right? Going down for the sell side here. You're bearish. But what happens, ICT, if it goes up? You'll probably lose money. But let's count how many up close candles we have. 1, 2, 3, 4, 5. Look how much range it moved. If you can't have a model that weathers, say you got a losing trade each one of those days, if that blows your account, you're not managing your risk properly. You're over leveraging or over trading.